Friday, September 4th, 2020, Maneco 64, home of alternative economics and contrarian views. Today, we're going to look at how Alan Greenspan admits that it was the Federal Reserve and not the gold standard or gold that triggered the Great Depression in the 1930s. That's an argument a lot of mainstream economists, Keynesians, all the people that are linked to this system that we have nowadays use. They say we can't go back on a gold standard. We need the Federal Reserve. I'm going to show you an article as well that shows this kind of mindset. And I'm going to recommend you a book called America's Great Depression by Murray and Rothbard that is very much in line with Alan Greenspan's view. Before I start though, I'd like to thank all the viewers, subscribers for their ongoing support of the channel, through their comments, through their support as well, through PayPal, Patreon, through the Teespring store. It helps. Thank you very much, so we can keep going and exposing this fraudulent central banking monetary system that we have, that is based, of course, on one of the planks of the Communist Manifesto, which is centralized credit, right? So let's go straight to Alan Greenspan and his admission. This was in 1967, of course, but as I've told you many times before, when I met Ron Paul at the Mises Institute, he told me the story that he asked Alan Greenspan to autograph or to sign this essay for him when they were in Congress together, right? Ron Paul used to grill Alan Greenspan with questions during congressional testimony, right? And so Alan Greenspan signed or autographed the essay for Ron Paul, and Ron Paul asked him, do you still believe in everything you said in 1967 in this essay? He said, of course I do. So let's go to what he says here about the banking system, about the Fed, about gold. And I quote, "A fully free banking system and fully consistent gold standard have not as yet been achieved. But prior to World War I, the banking system in the United States and in most of the world was based on gold, and even though governments intervened occasionally, banking was more free than controlled. Periodically, as a result of overly rapid credit expansion, banks became loaned up to the limit of their gold reserves. Interest rates rose sharply, new credit was cut off, and the economy went into a sharp but short-lived recession. Compared with the depressions of 1920 and 1932, the pre-World War I business declines were mild indeed. It was limited gold reserves that stopped the unbalanced expansions of business activity before they could develop into the post-World War I type of disaster. The readjustment periods were short, and the economies quickly reestablished a sound basis to resume expansion. But the process of cure was misdiagnosed as the disease. If shortage of bank reserves was causing a business decline, argued economic interventionists, why not find a way of supplying increased reserves to the banks so they never need be short? If banks can continue to loan money indefinitely, it was claimed, there need never be any slumps in business. And so the Federal Reserve System was organized in 1913. It consisted of 12 regional Federal Reserve banks, nominally owned by private bankers, but in fact, government-sponsored, controlled, and supported. Credit extended by these banks is in practice, though not legally, backed by the taxing power of the federal government. Technically, we remain on the gold standard. Individuals were still free to own gold, and gold continued to be used as bank reserves. But now, in addition to gold, credit extended by the Federal Reserve banks, paper reserves, could serve as legal tender to pay depositors. When business in the United States underwent a mild contraction in 1927, the Federal Reserve created more paper reserves in the hope of forestalling any possible bank reserve shortage. More disastrous, however, was the Federal Reserve's attempt to assist Great Britain, who had been losing gold to us because the Bank of England refused to allow interest rates to rise when market forces dictated. It was politically unpalatable. The reasoning of the authorities involved was as follows: if the Federal Reserve pumped excessive paper reserves into American banks, interest rates in the United States would fall to a level comparable with those in Great Britain. This would act to stop Britain's gold loss and avoid the political embarrassment of having to raise interest rates. The Fed succeeded. It stopped the gold loss, but it nearly destroyed the economies of the world in the process. The excess credit which the Fed pumped into the economy spilled over into the stock market, triggering a fantastic speculative boom. Sounds familiar? Belatedly, Federal Reserve officials attempted to sop up the excess reserves and finally succeeded in breaking the boom, but it was too late. By 1929, the speculative imbalances had become so overwhelming that the attempt precipitated a sharp retrenching and the consequent demoralizing of business confidence. As a result, the American economy collapsed. Great Britain fared even worse, and rather than absorb the full consequences of her previous folly, she abandoned the gold standard completely in 1931, tearing asunder what remained of the fabric of confidence and including a worldwide series of bank failures. The world economies plunged into the Great Depression of the 1930s. So there you go. At least this time around, through this Great Recession, if you want to call it, it might get worse. They won't be able to blame gold because we're not on a gold standard. They can blame the real culprits, the central banks. And that's why you need to read this book as well by Murray Rothbard of the Austrian School of Economics. It was written in 1963. It says here, Rothbard produced in 1963 his own explanation, which turned the conventional one on its head. The conventional one, of course, was that the free market and capitalism didn't work. But we saw from Greenspan that that wasn't the case, right? There was interference from the central bank along with the government. The severity of the Wall Street crash, he argued, was not due to the unrestrained license of a freebooting capitalist system, but to government insistence on keeping a boom going artificially by pumping in inflationary credit. And who does the pumping of the inflationary credit? Well, it's the Federal Reserve. They did it back then. They're doing it today. So there you go. Just quickly go through this article here. It's in the New York Times by a guy called Stephen Ratner. He served as counselor to the Treasury Secretary in the Obama administration. So he was Mr. Geithner's advisor or counselor. And this is an opinion piece in the New York Times from July 22nd this year. He says, God help us if Judy Shelton joins the Fed. First, he says the Federal Reserve is an indispensable player in managing our economy, period. He doesn't give the reason why, right? So this is what Mr. Ratner says about the gold standard, because Judy Shelton is known to favor a gold standard and even ending the Fed, right? He says, then there's the gold standard, a significant culprit in deepening the Great Depression and abandoned decades ago by every country in the world, including the United States in 1973. By rigidly fixing prices to a single commodity, a gold standard exaggerates economic swings on balance for the worse. So we saw that it actually makes things more stable, right? As Greenspan said, because there's a limited supply of money. Yes, it is a commodity, but it's a monetary commodity, Mr. Ratner, and it's been money for thousands of years. The other fallacy he points out here are the business cycles prior to the Federal Reserve. And he says between 1880 and 1933, the United States experienced at least 5 full-fledged banking crises. In the past 87 years, we've had 2. Though promoted as smoothing price movements, a gold standard in fact magnifies them as a comparison of the pre-Depression period to the post-World War II era makes clear. So if we look at Greenspan and what he said about the gold standard and how the recessions or depressions were very sharp and shallow, the gold standard did not magnify these business cycles, as Mr. Ratner says. So there you go. Now let's look at the markets, and I recommend you watch an interview I did yesterday with Michael Oliver. He is a technical analyst. He's been in the market since 1975. He's got a company called Momentum Structural Analysis, and he gives his opinion of what's going on in the markets. I know we had huge drops yesterday in the markets, but I highly recommend you watch the interview. I kind of agree with what he says, and he also forecast the big drop in the stock market in the beginning of the year, the 30% plus crash. And if you want to know what he thinks is coming, yeah, watch that interview. I'll put it up in the cards and below in the description. So yesterday, of course, the NASDAQ led the way. The NASDAQ was down just under 5%, or 598 points. The Dow was down 807 points, 2.78%. S&P was down 3.5%. So right now it's 8:19 a.m. London. I saw overnight the stock market was weak when the futures reopened. We've rebounded a little bit here in the Dow and S&P futures. Gold and silver, I thought, held really well yesterday. Gold right now is at $19.34, up about $4. Range has been $19.25 to $19.42. Silver's up 18 cents at $26.76. Range has been $26.99 to $26.37. The Dow future is up 48 points at 28.334. The S&P is down half a point, so pretty much unchanged. The NASDAQ 100, though, is down 80 points, or 2/3%. I think we should continue to see more weakness in the stock market in the short term. Will we get a 35% crash in the next few weeks? Well, listen to Mr. Oliver and he'll tell you. The currencies this morning, we've got the pound unchanged at 132.80, the euro at 118.44, and the dollar yen is unchanged at 106.11. So it looks like the dollar strength is kind of stabilized for now. We've got the price of oil down 0.5% at 41.31. And of course, the bond market, the 10-year yield actually hasn't moved down that much, even though it moved down a couple of days ago. And I thought that was strange with the Dow being up like 450 points. Today we're up about 2 basis points in the 10-year yield at 0.64. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.